There is a particular kind of silence that only appears right before a system shifts. It isn't the calm of stability or the quiet of confidence. It's the stillness that settles in when the usual signals stop behaving the way they're supposed to, when familiar patterns no longer line up, and the machinery underneath continues moving even as the dashboard goes blank. That was the feeling in the silver market early Tuesday, January 27th. Not excitement, not panic. Something colder, more deliberate. The price didn't announce itself with chaos. There was no disorderly surge, no algorithmic frenzy, no frantic rush for liquidity. Silver simply moved to around $111 and held there with an unnatural firmness. For anyone who has watched metals markets long enough, that kind of behavior stands out immediately. Markets don't usually behave politely when they're repricing something important. They lurch, they overshoot, they correct. This didn't. It felt like a mechanism finally aligning with pressure that had been building quietly for a long time. The first place that pressure showed itself wasn't on a chart. It was in availability. Within minutes of the open, physical supply began disappearing. Not gradually, not dealer by dealer, but almost all at once. Listings vanished. Inventories flipped to unavailable, the kind of synchronized shortage that doesn't come from retail enthusiasm alone. It comes from something upstream breaking connection with the price everyone is watching. At the same time, the narrative coming from financial media was reassuring, almost detached. Analysts spoke in familiar tones about commodities finding balance, about healthy moves, about nothing fundamentally changing. That contrast is important. When official narratives lag physical reality, it's usually because the framework they rely on assumes continuity, assumes the system is functioning the way it always has. The problem is that systems rarely announce when they've crossed a threshold. They simply stop responding the way they used to. What made this moment different wasn't just the move in silver itself, but the behavior around it. Physical markets reacted instantly. Paper markets behaved as if nothing had changed. That divergence is the core of the story, because when the price of something is no longer capable of clearing real-world demand, the number you see becomes a reference, not a truth. To understand why this matters, it helps to strip silver of its mystique and think about it as a contract-based system. The quoted price is not the price of metal changing hands today, it is the price of a promise. A futures contract assumes delivery can occur later, under specific conditions, using inventory that exists somewhere in the background. As long as that assumption holds, the system functions smoothly. When it doesn't, the illusion of liquidity remains right up until it fails. What unfolded Tuesday was not a speculative frenzy. It was a synchronization event. Physical demand, arbitrage pressure, and delivery mechanics all converged at once. That's rare, and when it happens, price becomes a trailing indicator, not a leading one. One of the least discussed drivers of this move is the widening gap between paper pricing in the West and physical pricing in the East. In a balanced system, those prices converge quickly. Arbitrage exists to enforce that convergence. But arbitrage only works when supply is elastic. When metal can move freely, gaps close. When it can't, gaps become drains. At the time silver was trading near $111 in New York, buyers elsewhere were paying materially more for immediate physical delivery. Not future promises, not cash settlement equivalents. Actual metal. That difference isn't noise, it's incentive. Anyone with access to both sides of that trade has a reason to pull metal from one system and deliver it into another. And every ounce that leaves tightens the constraint further. This is where the structure of futures exchanges becomes critical. These markets were never designed for universal delivery. They rely on rollover, offsetting positions, and cash settlement to function efficiently. Only a fraction of contracts are expected to result in physical delivery. Registered inventory exists to satisfy that fraction. When delivery demand expands beyond expectations, the margin for error collapses quickly. The current situation is the result of years of gradual tightening. Inventories have been trending lower. Refining capacity has been operating closer to its limits. Meanwhile, demand from regions focused on physical settlement rather than paper exposure has been steadily increasing. None of this was dramatic on its own. Together, it created a brittle system. When pressure finally reached the surface, it didn't need to explode. It only needed to reveal that the old assumptions no longer applied. Another important signal came not from prices or inventories, but from behavior. Institutional silence matters. When experienced participants step back quietly during moments of stress, it's rarely coincidence. Risk isn't managed by headlines. It's managed by models, scenarios, and exposure limits. When those models start producing uncomfortable outputs, the response is subtle, not theatrical. At the retail level, psychology shifted just as clearly. In Japan, one of the world's largest precious metals dealers suspended silver sales entirely. Not delayed, not rationed, suspended. Lines formed hours before opening. This wasn't speculative trading. It was people deciding that ownership mattered more than price. That distinction changes everything. Markets can accommodate enthusiasm. They struggle with insistence. When buyers stop asking what something costs and start asking whether it's available, the pricing mechanism loses authority. The common counter-argument is familiar. We've seen silver spike before, only to collapse under margin pressure. We've seen metals sold to raise cash during crises. Those episodes are real, but they're not analogs. In those moments, physical supply was ample. Vaults were full. Delivery was possible. The paper market bent because it had room to bend. Today, that room is gone. Inventory buffers are thin. Refining lead times are stretched. Logistics are constrained. Even a modest increase in delivery demand has outsized effects when the system is already operating near its limits. This is why focusing solely on price misses the point. $111 is not the story. The story is that the mechanisms designed to absorb stress are no longer doing so smoothly. Arbitrage is no longer correcting imbalances. Delivery is no longer assumed. Physical availability is no longer guaranteed. That combination changes how every participant must think about risk. Contracts that once seemed interchangeable with metal are no longer viewed that way. Promises are being evaluated against the question of fulfillment. What we are witnessing is not a climax, but an inflection. A moment when a long-running divergence between paper structure and physical reality becomes visible enough that it can no longer be ignored. The tension that follows doesn't resolve quickly. It forces decisions. Once you step away from the emotion of price movement and look directly at the mechanics, the situation becomes less dramatic and more unsettling. This is no longer about sentiment or momentum. It's about arithmetic, timing, and constraints. Markets can survive fear. They struggle with math. The futures market functions on an assumption that rarely gets challenged directly. Most contracts will never require physical fulfillment. They exist to hedge, speculate, or manage exposure, not to move metal. That assumption allows the system to operate with leverage far beyond what would be possible if every participant demanded delivery. It's efficient, flexible, and profitable until the day delivery becomes the focus instead of the exception. What changed recently is not that delivery suddenly matters, but that it matters to more participants at the same time. When delivery requests are isolated, they are manageable. When they begin to cluster, they expose the narrowness of the physical buffer supporting the entire structure. Registered inventory is the key pressure point. This is the category of metal that is actually available to satisfy delivery obligations. Eligible inventory may exist in the same vaults, but it cannot be used unless the owner explicitly agrees. That distinction is critical. On paper, inventory levels may appear adequate. In practice, availability depends on willingness, not existence. Now consider the pace of outflows. Even under conservative assumptions, no panic, no acceleration, no extraordinary events, a steady drain of physical metal through arbitrage and delivery quickly overwhelms the system. 10% weekly outflows don't sound catastrophic until you realize how small the base has become. At that rate, the cushion disappears in weeks. This is where the conversation often turns to rule changes. Exchanges have options. They can raise margins, alter delivery terms, encourage cash settlement, or impose restrictions. These tools can slow price action, but they cannot create metal. They address symptoms, not causes. Margin hikes are the most visible response. By increasing the cost of holding positions, exchanges force leveraged traders to exit. Prices often drop sharply as a result. This creates the illusion that the problem has been solved. But price suppression does not restore inventory. It does not reduce physical demand. In fact, it can intensify arbitrage by lowering the paper price relative to physical markets elsewhere. Trading restrictions are another lever. Position-only rules, temporary halts, and other emergency measures are framed as stability tools. In reality, they signal strain. Markets resort to restrictions when normal mechanisms fail to maintain order. Every restriction erodes confidence a little further. The deeper issue is that delivery demand is no longer theoretical. It is being driven by participants who do not view silver as a trade, but as an asset to be owned outright. When buyers insist on physical settlement, paper flexibility disappears. A contract either delivers metal or it doesn't. There is no narrative workaround for that moment. Compounding this problem is the state of the physical pipeline. Refining capacity is not elastic. Only a limited number of facilities produce bars that meet exchange specifications, and those facilities cannot scale output quickly. Lead times stretching into months mean that even rising prices cannot summon supply fast enough to relieve pressure. Logistics add another layer of friction. Transportation, insurance, and verification are not abstract processes. They require coordination and time. When demand rises simultaneously across regions, bottlenecks appear. Those bottlenecks delay replenishment and magnify scarcity. This is why historical comparisons are misleading. In previous silver sell-offs, supply was available. Metal could be sourced, refined, and delivered. The paper market corrected because it had room to breathe. Today, the system is operating with minimal slack. Any disruption has immediate consequences. Institutional behavior reflects this reality. When risk becomes unquantifiable, institutions reduce exposure quietly. They do not wait for confirmation in headlines. They act on internal stress tests and probability distributions. The absence of public commentary does not indicate calm. It often indicates uncertainty. Retail behavior reinforces the signal. When dealers suspend sales, it is not because demand is inconvenient. It is because risk has overtaken pricing models. Selling metal when replacement costs are unknown is a losing proposition. At that point, withholding supply becomes rational. This shift in behavior marks a transition from a price-driven market to an availability-driven one. In such markets, price loses its coordinating role. Premiums detach. Quoted numbers become placeholders. Transactions move to negotiation. At the core of this transition is trust. Futures markets function because participants trust that contracts represent something deliverable. When that trust weakens, the entire structure wobbles. Participants begin to question not just silver contracts, but the integrity of related markets. Silver may be a small market by total value, but its connections are extensive. It sits within a web of derivatives, collateral agreements, and structured products. A disruption here does not stay contained. It tests assumptions across the system. If delivery obligations cannot be met smoothly, confidence erodes. When confidence erodes, liquidity dries up. And when liquidity dries up, volatility follows. Not because of panic, but because the system loses its ability to clear trades efficiently. This is why the current moment matters, even if prices fluctuate tomorrow. A pullback does not resolve structural strain. It merely redistributes it. The question is not whether silver can be pushed lower temporarily, but whether the mechanisms that support pricing can continue operating without intervention. The tension now is between time and capacity. Delivery cycles are fixed. Refining timelines are fixed. Logistics are fixed. Demand is not. When demand accelerates against fixed constraints, outcomes become predictable. When physical limits start asserting themselves, the consequences don't remain confined to the market where the stress first appears. They propagate outward, touching systems that were never designed to handle uncertainty at the foundation. Silver happens to be one of those pressure points where abstraction meets reality, and that's why its behavior matters far beyond its market size. One of the most misunderstood aspects of this situation is infrastructure. It's easy to imagine that if an exchange needs metal, it can simply acquire it. In practice, every step between ore in the ground and a deliverable bar introduces delay and friction. Mining output cannot be increased on command. Most silver is produced as a byproduct of other metals, which means supply decisions are driven by copper, lead, and zinc economics, not silver prices. Even if prices surge, production does not respond quickly. Refining is an even tighter bottleneck. Exchange-approved bars require specific purity, stamping, and certification standards. Only a small number of refineries meet those requirements, and they are already operating near capacity. When delivery demand rises faster than refined output can be produced, inventory declines become irreversible in the short term. Price signals lose their corrective power. Transportation adds further constraints. Moving large quantities of precious metal is not trivial. It requires secure logistics, insurance, and coordination across jurisdictions. In a stressed environment, delays compound. What looks like an adequate inventory number on paper can become inaccessible due to timing alone. This is why registered inventory figures can be misleading. Metal may exist within the system, but that does not mean it is available. Owners are under no obligation to convert eligible metal into registered metal simply because prices rise. Many long-term holders place their metal in storage precisely to avoid reacting to short-term fluctuations. If they believe structural pressure is increasing, their incentive to sell diminishes, not increases. As availability tightens, the market begins to change character. Premiums rise independently of spot prices. Dealers shift from fixed pricing to call for price models. Transactions slow, not because demand disappears, but because risk becomes difficult to price. At that point, the quoted price becomes informational rather than actionable. The implications extend into the broader financial system through collateral chains. Commodity contracts are often used as collateral in short-term funding markets. Their value rests on the assumption that they represent something real and deliverable. When that assumption is questioned, lenders become cautious. Haircuts increase. Liquidity evaporates. We have seen this dynamic before, not with metals, but with mortgage-backed securities. The pattern is the same. Confidence disappears before collapse becomes visible. Silver's role here is not unique because of its size, but because of its function. It is both an industrial input and a monetary asset. It bridges physical production and financial abstraction. Stress in silver tests whether the system can honor its promises when physical settlement becomes central. Another layer to consider is the behavior of sovereign actors. Nations seeking to reduce dependence on dollar-based systems have a strategic interest in exposing weaknesses in Western financial infrastructure. Commodity markets are an efficient way to do that quietly. By prioritizing physical settlement, accumulating reserves, and supporting alternative exchanges, they can shift pricing power without confrontation. This does not require coordination in the dramatic sense. Incentives alone are sufficient. When physical pricing elsewhere reflects higher demand, metal flows naturally toward those markets. Over time, this undermines the credibility of benchmarks that cannot deliver. Psychology amplifies these dynamics. For years, precious metals investors were dismissed as alarmist. Many were early, and early looks wrong until it doesn't. When price action aligns with structural arguments, attention shifts rapidly. Retail demand increases not because of charts, but because narratives change. Ownership becomes a priority. In constrained markets, retail demand has disproportionate impact. Supply cannot scale. Premiums rise. Availability declines. This feeds back into perception, reinforcing the sense that access matters more than price. The loop tightens. This brings the discussion back to risk management. Holding silver is not about predicting price targets. It is about positioning against a category of risk that traditional assets do not address well. Most financial assets require functioning systems to realize their value. Silver does not. It exists independently of exchanges, banks, and payment networks. That independence carries costs. There is no yield. Storage and security are required. Price volatility can be uncomfortable. But insurance is not purchased for comfort. It is purchased because certain outcomes, while unlikely, are unacceptable. The asymmetry is straightforward. If the system continues functioning smoothly, silver underperforms relative to productive assets. If the system experiences stress that impairs settlement, liquidity, or trust, silver retains value precisely because it is outside those mechanisms. The downside is limited. The upside is protection. Looking at the broader pattern, the signals are consistent. Arbitrage gaps persist. Inventories decline. Refining and logistics strain. Institutional exposure quietly reduces. Retail demand shifts from curiosity to urgency. Eastern markets assert physical pricing power. None of these alone guarantees a crisis. Together, they describe a system operating without margin for error. This is not a call to action. It is an observation. Systems built on assumptions function until those assumptions are tested. When delivery becomes central rather than peripheral, flexibility disappears. Rules change or failures occur. What remains uncertain is timing. Structural breaks unfold unevenly. They produce false resolutions and temporary reversals. Prices move up and down. Narratives shift. But the underlying constraints do not disappear. Understanding this moment does not require agreement. It requires recognition of the mechanism. When markets designed around promises encounter insistence on fulfillment, outcomes are determined by capacity, not confidence. That is the tension now embedded in the silver market. It is not loud. It is not chaotic. It is quietly forcing participants to reassess what they believe a price represents. And once that reassessment begins, it rarely stops where it started.